Volatility seems to have disappeared, hasn't it? We've been looking at readings on the VIX, sort of in the 11, 12 range, more or less stuck around 12 for some time, and it really hasn't moved very much. That's not necessarily unwarranted given the absolute lack of realized volatility or historical volatility that we've seen. Right now, the S&P index has more or less been realizing somewhere between 6 and 8, and what we're talking about there on a daily basis, remember your rule of 16, on a daily basis, an 8 annualized volatilities is roughly a movement of 0.5% a day, and that's top to bottom. So we're seeing very, very muted moves in the market, and that's being reflected in low levels of the VIX. And you can say, well, 12 VIX on a 6 to 8 historical volatility, that's actually rather high, isn't it? And in some point of view, that is. Now, remember, the VIX is not necessarily looking at exactly the same thing. It's a mixed measure of it's rolling as to where the market anticipates 30-day volatility to be. So it's a bit susceptible to a skewed curve in the VIX. Markets tend to look outwards and think that it could be more volatile in the future. The curve is in contango, as you would, where you see higher future values above current levels. And so that generally explains why you see a level of the VIX above the actual historical reading. But this right now is a situation that looks a lot like it did earlier this year. Unfortunately, we all know how that ended. There are some parallels in terms of the fact that historical volatility is remarkably low. The markets just seem to grind higher every day, which suppresses vol. Partially, number one, because it's not moving around too much. It's just sort of grinding itself higher most days. And secondly, it's doing it on an absence of fear, so you really don't have a lot of demand for protection. That's not necessarily the case because we do see skew being very steep. That means there are still buyers of protective puts out there. I think that you'll see that at least into the election, and truthfully, I think you may see that throughout the remainder of the Trump administration, because there just seems to be a perpetual undercurrent of political volatility, although most of it does not come back into the marketplace. And I think you'll see that demand. But in terms of at-money hedging, you're really not seeing that much of it. And my worry becomes, do markets hit a point where they become too complacent and leave themselves susceptible to some sort of hiccup? What that hiccup is, that's always impossible to say. But that becomes the situation. I think right now, if you are nervous, it's not a very expensive time to hedge. I really don't recommend that people try to short volatility unless they really have a very high risk tolerance and really know what they're doing. Because when you get down to it, where's that going to go? If you're shorting the VIX with an 11 handle, what are you hoping to achieve? Maybe it'll get below 10, but one day some piece of news comes out and the thing's at 17, and it's the risk reward I think sets up terribly for shorting volatility into this environment on the market itself. You can look to individual names, and of course that such a multitude. There's always going to be something that's worth buying and something that's worth selling. But I think right now we'll see where things take us. This market seems remarkably resilient to international worries. The Italian budget stuff, was a problem for a couple of mornings, and the market more or less forgot about them by 10:30 or 11 o'clock. The Supreme Court stuff really isn't a market mover. The midterms may or may not be, but people, I don't think, are really focused on them from a market point of view. And so we remain in a quiet volatility environment until or unless something exogenous changes it.